All right, welcome to Iron Financial, the show where we help you forge a stronger portfolio by cutting right through the market noise. I'm your lead analyst, and I live and breathe the numbers. And with me, making sure we stay honest, is our market skeptic. He's here to ask the tough questions. Today, we're taking a sledgehammer to the biggest bank in America, JPMorgan Chase. They love to call their balance sheet a fortress, something built to withstand any storm. But we all know even the strongest walls have a price. So the question we're asking today is simple. Is this financial titan a solid stronghold for your money? Or is it just a massive, incredibly expensive facade? Let's get to work. So picture this. April 14th, 2026. JPMorgan drops its first quarter earnings report, and the market immediately snaps to attention. I mean, when a company with assets measured in the trillions speaks, you listen. But we're not just here to listen. We're here to dissect. We're going to tear this report apart, brick by brick, number by number, to see what this fortress is actually made of. We're going to check the engine rooms, listen in on the command center, and run the simulations that show what happens when the pressure is really on.
Okay, let's get right to it. The headline numbers. This is the first thing every trader and analyst on the street looks at. On the left, you've got Wall Street's best guess. The consensus was looking for earnings per share of $5.46 on revenue just a hair under $50 billion. Now look to the right, the actual results. JPM comes in and drops $5.94 a share on revenue that clears the $50 billion mark. Look, this isn't just a beat, this is a blowout. They absolutely crushed the earnings estimate by almost 9%. On the surface, this is an undeniable, powerful win for the bank. This is what leadership looks like.
Now, let's translate that earnings beat into what really matters, cold, hard cash. $16.5 billion. Let that number sink in for a second. That's their net income for a single quarter. It's up a solid 13% from this time last year. This is a truly staggering number. I mean, to put it in perspective, it's more than the entire annual economic output of countries like Jamaica, Iceland, and Armenia put together. This is the profit that builds their war chest, that fuels the stock buybacks, that pays out the dividends, and, that reinforces the walls of this so-called fortress. This right here is the foundation of their power.
Okay, hold on. $16.5 billion is a monster number. No one's going to argue with that, but you and I both know that big numbers can hide big problems. My job here is to question the quality of that number. How exactly did they get there? Was it from solid, repeatable business that they can do again next quarter and the quarter after that? Or was this just a one-time sugar high from a hot market? And more importantly, what is the cost of generating that profit? Because even the most impressive fortress in the world is totally useless if the cost to maintain it is so high that it just crumbles from the inside out. We need to check the structural integrity, not just admire how tall the walls are.
And that's exactly where we're headed. So here's our plan of attack for today. First, we've already covered that big headline beat. Done. Next, we're going under the hood to look at the profit engines, the individual business segments that are doing all the heavy lifting. Then we'll dial in on the view from the top, analyzing the warnings from the CEO, Jamie Dimon himself. After that, we put the whole thing to the ultimate test, a simulated doomsday economic scenario. And finally, we deliver our verdict. Let's dig in.
All right, section 2. Let's get inside those profit engines. Look, a fortress is only as strong as the machinery that's operating inside of it. You can have the thickest, strongest walls in the world, but if the engines of commerce inside aren't firing on all cylinders, it's really just a museum. So right now, we're going to break down JPMorgan's core business segments. We need to see which ones are pulling their weight and which ones might be showing signs of wear and tear.
So what you're looking at here is the master blueprint. This is that diversification that the bulls just love to talk about. You've got three main pillars holding up the entire structure. First, the corporate and investment bank, or CIB. That's your classic Wall Street trading, M&A deals, the whole 9 yards. Then you have the consumer and community banking, CCB. That's the Chase brand you see on every street corner, handling checking accounts, credit cards, mortgages. And finally, asset and wealth management, AWM, which is the quiet giant that manages trillions of dollars for huge institutions and the super rich. The point is, this isn't a one-trick pony. It's a diversified financial machine. Let's drill into the biggest engine first. Let's start with the CIB, the big guns, the investment bank. And wow, just look at that number. Investment banking fees are up a massive 28% year over year. After a couple of pretty sleepy years, deal-making is back, and it's back with a vengeance. M&A is hot again, companies are rushing to issue new stock, and JPMorgan is sitting right in the middle of it all, collecting a fee on pretty much every major transaction. This is a huge rebound, and it's a primary driver of that big earnings beat we saw a few minutes ago. This is the high-margin, high-octane stuff that can really supercharge profits when the market conditions are just right.
And this isn't just a lucky punch, this is pure dominance. They're not just riding the wave of the rebound, they are the wave. They have the #1 spot in global investment banking fees, capturing almost 10% of the entire global pie. That is raw market power. And it wasn't just about the deals. Their trading desks had an absolutely monstrous quarter, a record $11.6 billion in markets revenue, up 20%. Both their fixed income and their equities trading desks were on fire, up 21% and 17%. It's simple. When the market gets volatile, their traders don't just survive, they thrive. This part of the fortress is clearly battle-hardened and firing on all cylinders.
Now let's turn our attention to that second engine, asset and wealth management. This is the quieter but incredibly powerful part of the business. It's like a silent giant. It's just a magnet for money. Their assets under management, or AUM, swelled by 16% to a colossal $4.8 trillion. And they're not just sitting on that cash, they're putting it to work, generating an 11% increase in revenue year over year. This is a super sticky, fee-based business that provides a steady, incredibly reliable foundation of profit quarter after quarter. This right here is the granite foundation that the whole fortress is built on.
And then there's the third major engine, the one that runs on Main Street, not just Wall Street, the consumer bank. And on the surface, the metrics here look really robust. They brought in over 450,000 net new checking accounts in just one quarter. Engagement on their mobile app is up, and crucially, people are out there spending money. Debit and credit card sales volume jumped 9%. That points to a resilient consumer who is still confident enough to be out there swiping their Chase card. This really does paint a picture of a healthy, growing, and engaged customer base, which is basically the lifeblood of the U.S. economy and definitely of this bank.
Okay, easy there. New accounts, happy customers using the app, everyone's swiping away. It sounds like a fairy tale. But my job is to ask, what's the catch? Because for a bank, growth often means taking on more risk. So the really important question is this healthy growth? Are all these new customers actually high-quality borrowers? When I see spending go up by 9%, my very first thought is, great, but are they paying their bills at the end of the month? Because if they're not, that growth is just a future loss waiting to happen. I'm looking for the cracks in the consumer's armor. Let's see if we can find one.
And there it is, right here. This is the first hairline crack in the fortress wall, 3.47%. That is the net charge-off rate for their credit card business. Now, in plain English, that's the percentage of credit card debt that the bank has basically given up on. They believe they will never, ever collect it. Now, this isn't just a JPMorgan problem. This is a flashing yellow light for the entire economy. When you see this number start to tick up, it means more everyday people are struggling to pay their bills. It's a classic early warning sign of stress on the consumer. It's still a pretty small number right now, but it's a number you have to watch like a hawk. This is how a fortress can start to take on water, not from a big cannonball attack, but from a slow, steady, quiet leak.
Now let's zoom back out from that specific crack and look at something systemic. This right here is a huge red flag for me. On the left, you see the firm-wide revenue growth, up a very strong 10%. That's the number the bulls are cheering about. But look to the right. Firm-wide expenses are growing even faster, up 14%. This is what we call negative operating leverage, and it's a cardinal sin in business. Put simply, it means their costs are growing faster than their income. They're spending more on salaries, on marketing, on new tech, you name it. A fortress with rising maintenance costs is a fortress that's becoming less efficient and less profitable over time. This isn't just a leak, this is a potential structural problem.
Okay, so we've got a mixed bag, right? Powerhouse numbers on one side, but some worrying trends on the other. So where do we go from here? We go to the top. We go to the command center. What is the general, CEO Jamie Dimon, actually saying about all this? Sometimes the qualitative data, his specific commentary, can be even more revealing than all the spreadsheets in the world. Let's see how he's framing the future.
And naturally, Jamie Dimon starts with a victory lap. You have to. The very first line of his official statement is pure confidence. The firm delivered strong results. He makes sure to highlight that massive $16.5 billion net income figure right at the top. This is the message he wants to hammer home to the market. The fortress is secure, our performance is solid, and management is in complete control. This is the bull case, straight from the horse's mouth. He's building that narrative of an unshakable financial institution.
But then, literally in the next breath, the victory music stops, and he drops this. He lays out this whole laundry list of fears. And this isn't just your standard corporate speak about risks and uncertainties. No, he's being incredibly specific here. He's talking about geopolitical tensions, wars, energy price shocks, trade wars, government debt, asset bubbles. So the question for us is, what is he really telling us?
Is it just its CEO covering all his bases, or is the man at the top of the biggest, most important bank in the world genuinely trying to warn investors that the strong results we just saw might not last? What is he so afraid of?
These aren't just vague worries. Let's really break down what he's pointing to. He calls them storm clouds gathering on the horizon. He sees multiple potential attacks coming from every direction. You've got geopolitical conflict that could completely disrupt markets. You've got energy price spikes that could cripple the consumer. You've got trade wars that could suffocate global growth. And then you have massive government spending that could keep fueling inflation, while sky-high asset prices suggest a bubble just waiting for a pin. The leader of the fortress is explicitly telling all of us that the world outside his walls is getting more dangerous and more unpredictable by the day. And so that leads to the billion-dollar question, or in this case, the trillion-dollar question. If those storm clouds that Diamond's so worried about do break, can the fortress actually handle it? It's one thing to look strong and powerful when the economy is chugging along. It's a whole other thing to withstand a direct hit from a full-blown economic catastrophe. And luckily for us, we don't have to guess. The regulators force these banks to run a simulated doomsday scenario every single year. It's called the DFAST stress test. This is where we find out if the walls can truly withstand the storm.
So, what exactly is this thing? Well, you can think of it like a simulated economic hurricane. The Federal Reserve comes up with a severely adverse scenario. It's a total nightmare combination of a deep global recession, unemployment skyrocketing, and stock and real estate markets absolutely crashing. The bank then has to run that exact scenario through its own books to project the hypothetical damage over 2 years. The whole point is to answer one single critical question. If the absolute worst happens, do you have enough capital, enough of a safety buffer, to absorb all the losses and keep the lights on without needing another taxpayer bailout? All right, brace yourselves, because this is the damage report from that simulated hurricane. This table shows the hypothetical P&L over that 9-quarter doomsday scenario. You start with their baseline operating profit of about $73 billion, but then the losses hit hard. A staggering $83 billion in provisions for bad loans, people and companies defaulting. Then another $21 billion in trading and counterparty losses. When you add it all up, the simulation projects a cumulative pre-tax loss of $34.6 billion. That's a massive black hole of red ink.
Whoa, hold on. A nearly $35 billion loss? That sounds like game over. We just saw they made $16.5 billion in a great quarter. This projection shows them losing more than 2 great quarters worth of profit. So, is that it? The walls come crumbling down? Does the fortress just collapse? Can any bank actually absorb a hit of that magnitude and survive? This is the core question right here.
And this slide right here gives us the answer. And it's a crucial one. See, it's not about whether you take losses. In a severe crash, everybody takes losses. It's about whether your capital foundation is strong enough to absorb those losses. The key metric is called the CET1 capital ratio. Just think of it as the bank's highest quality shock absorber, measured as a percentage of its risky assets. Regulators set a non-negotiable minimum floor at 4.5%. And as you can see from the chart, even after simulating that $35 billion loss, JPMorgan's capital ratio remains well above that minimum requirement. The fortress bends, it takes on heavy damage, but it does not break, the walls hold. This is the ultimate proof behind that fortress balance sheet claim.
Okay, we've reviewed the massive headline beat. We've inspected the profit engines, we've listened to the CEO's own warnings, and we've put the entire structure through a brutal stress test. Now it's time to put it all together. Section 5, the final verdict. Based on everything we've just seen, is JPMorgan Chase an opportunity for your portfolio, or is it a trap?
So here's how it all stacks up. The bull case versus the bear case. Let's put them in the ring. On the bull side, the argument is powerful. You have an incredibly diversified revenue stream. You have record-breaking performance in its most important divisions like investment banking and trading. They have a dominant, almost unassailable market share in key businesses. And, as we just saw, the fortress passes the government's doomsday scenario with room to spare. But the bear case is just as compelling. You have expenses that are rising faster than revenue. That's just not sustainable. You're seeing the first undeniable cracks appearing in consumer credit, and the CEO himself is basically shouting from the rooftops about a minefield of risks on the horizon.
Look, my final take comes down to the engineering. You have to respect the build quality here. The foundation is absolutely solid. This stress test proves that. This isn't some house of cards waiting for a gust of wind. It's a fortress built on the bedrock of diversified revenue streams and a market position that is second to none. It has proven through hardcore simulations that it can take an immense amount of punishment and remain standing. For any investor who's looking for stability and leadership, the structural integrity is there, no question about it.
But hold on. A fortress that costs too much to maintain is a liability, not an asset. And that's what worries me. You cannot ignore the rising costs of upkeep. Those climbing expenses are a real problem. They are eating away at profitability and efficiency. That's the high maintenance cost. And those cracks in consumer credit? That's the first sign of water seeping into the foundations. You absolutely have to watch those warning signs. Resilience is great, but a profitable investment needs more than just survival. It needs efficient growth. Don't let the sheer size of the fortress blind you to the very real cost of its upkeep.
And that leaves us with the final, critical question that you have to consider for your own portfolio. In a world that is clearly full of the exact risks that Jamie Dimon himself laid out, is this financial fortress the ultimate safe harbor for your capital? Or does its enormous size, its complexity, and its position at the absolute center of the global financial system simply make it the biggest and most obvious target when that next storm finally hits? That's the question you have to answer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.